Question 1. An investor living in New York City purchases general obligation bonds issued by the City of New York. What is the federal, state, and local tax status of the interest received from these bonds? A. Federally taxable, state taxable, local taxable. B. Federally exempt, state exempt, local exempt. C. Federally exempt, state taxable, local taxable. D. Federally taxable, state exempt, local exempt. Answer: B. Federally exempt, state exempt, local exempt. Interest income from municipal bonds is generally exempt from federal income tax. Additionally, if an investor purchases a municipal bond issued by a municipality within their own state of residence, the interest income is typically exempt from state and local income taxes as well. This is known as the triple tax exemption. For example, a New York City resident buying New York City municipal bonds would receive tax-exempt interest at all three levels of government. Remember that for municipal bonds, the taxability at the state and local level depends on where the investor lives relative to where the bond was issued. Question 2. Which of the following statements is most accurate regarding the payment source for general obligation, GO, bonds? A. They are backed by the revenues generated from a specific project. B. They are secured by the full faith, credit, and taxing power of the issuing municipality. C. They are repaid from lease payments made by a corporation. D. They are guaranteed by the U.S. government. Answer: B. They are secured by the full faith, credit, and taxing power of the issuing municipality. General obligation bonds are known as full faith and credit bonds because they are backed by the issuer's ability to levy taxes, including property taxes, sales taxes, and income taxes. This broad taxing power provides a strong guarantee of payment, making GO bonds generally very safe investments. For instance, a state might issue GO bonds to fund improvements to public roads or schools, with the repayment coming from its general tax revenue. Think of GO bonds as being backed by the general financial health and taxing authority of the government entity. Question 3. A municipal bond underwriter must obtain a copy of the official statement from the issuer. A. Only if the issue is a negotiated underwriting. B. Only if the issue is a competitive underwriting. C. For all new municipal bond issues, if one is prepared. D. Only if requested by the MSRB. Answer: C. For all new municipal bond issues, if one is prepared. The official statement is the primary disclosure document for a new municipal bond issue, providing critical information about the issuer, the bond, and its financial details to potential investors. Underwriters are required to obtain and distribute copies of the official statement to potential purchasers in a timely manner, regardless of whether the underwriting was negotiated or competitive, assuming an official statement is prepared. This ensures that investors have access to the necessary information to make informed investment decisions, similar to how a prospectus functions for corporate securities. Always ensure you understand the issuer and bond details before investing in any new issue. Question 4. What is the primary role of the bond counsel in a new municipal bond issue? A. To advise the issuer on the best pricing strategy for the bonds. B. To market and sell the bonds to investors. C. To render an opinion on the legality and tax-exempt status of the bond issue. D. To manage the bond proceeds and ensure they are used appropriately. Answer: C. To render an opinion on the legality and tax-exempt status of the bond issue. The bond counsel is a specialized law firm that examines all legal aspects of a proposed municipal bond issue to ensure it complies with applicable laws and regulations. Their primary role is to provide a legal opinion, often printed on the bond certificate, affirming the bond's validity and, crucially, confirming that the interest income is tax-exempt. This legal opinion is vital for investors because it assures them the bonds were legally issued and that they can expect the promised tax benefits. Without a clean legal opinion, a municipal bond issue is highly unlikely to be marketable. Question 5. Which of the following municipal bonds would be most likely to be issued with a debt service coverage ratio? A. General obligation bonds. B. Public housing authority bonds. C. Revenue bonds. D. Industrial development revenue bonds, IDRs. Answer: C. Revenue bonds. Debt service coverage ratio, DSCR, is a financial metric used to assess the ability of a project's cash flow to cover its debt payments, and it is most relevant for revenue bonds. Revenue bonds are backed by the specific revenues generated from a particular project, such as tolls from a turnpike or user fees from a hospital. Analyzing the DSCR helps investors understand if the projected revenues are sufficient to cover the bond's principal and interest payments. For example, a turnpike authority might issue revenue bonds, and the DSCR would show how many times the annual toll revenue covers the annual debt service. Question 6. An investor who needs a municipal bond offering maximum safety of principal would most likely consider: A. Moral obligation bonds. B. Public housing authority, PHA bonds. C. Special assessment bonds. D. Industrial development revenue, IDR, bonds. Answer: B. Public housing authority, PHA bonds. Public housing authority, PHA, bonds are considered one of the safest types of municipal bonds because they are backed by the full faith and credit of the U.S. government through guarantees from the Department of Housing and Urban Development, HUD. This federal backing significantly reduces credit risk for investors, making them attractive for those seeking high safety. For example, local housing authorities issue these bonds to finance low-income housing, and the federal guarantee provides a strong assurance of repayment. Always remember that federal backing offers the highest level of security available for municipal bonds. Question 7. What is the purpose of a legal opinion in a municipal bond offering? A. To determine the competitive bid for the bonds. B. To assess the creditworthiness of the bond issuer. C. To certify the legality and tax-exempt status of the bonds. D. To set the reoffering yield for the bonds in the secondary market. Answer: C. To certify the legality and tax-exempt status of the bonds. The legal opinion, provided by bond counsel, is a crucial document in a municipal bond offering. It is a formal statement attesting to the legality of the bond issue and, most importantly for investors, confirming whether the interest income is exempt from federal and possibly state and local taxes. This opinion assures investors that the bonds were issued in compliance with all applicable laws and regulations and that the expected tax benefits will be realized. A qualified legal opinion might raise concerns about the tax-exempt status, making the bonds less attractive. Question 8. Which of the following municipal bond issues would typically be considered a double-barreled bond? A. A general obligation bond backed by property taxes. B. A revenue bond backed by bridge tolls and also by the full faith and credit of the city. C. An industrial development revenue, IDR, bond. D. A special assessment bond used to fund specific improvements. Answer: B. A revenue bond backed by bridge tolls and also by the full faith and credit of the city. A double-barreled bond is a type of municipal bond that has two sources of repayment, offering enhanced security to investors. Primarily, it is a revenue bond backed by the revenues of a specific project, such as bridge tolls or water fees. However, it also includes a secondary pledge of the full faith and credit of the issuing municipality, acting as a backup if the project revenues are insufficient. For instance, a municipality might issue bonds for a new convention center, pledging both the convention center's revenues and its general taxing authority. This dual backing generally provides greater safety than a pure revenue bond. Question 9. An investor in a high tax bracket would find which of the following municipal bond yields most appealing? A. A high nominal yield. B. A high current yield. C. A high tax equivalent yield. D. A low yield to maturity. Answer: C. A high tax equivalent yield. For an investor in a high tax bracket, the actual return they receive on a taxable investment is reduced by taxes. A tax-equivalent yield, TEY, calculates the yield a taxable bond would need to offer to produce the same after-tax return as a tax-exempt municipal bond. A high TEY means the tax-exempt municipal bond offers a more attractive after-tax return compared to taxable alternatives. For example, if a muni bond yields 4% and an investor is in the 30% tax bracket, the tax-equivalent yield would be 4%/1 to 0.30 equals 5.71%. Always compare the TEY of a municipal bond to the taxable yield of other investments to understand the true benefit. Question 10. All of the following are typically considered short-term municipal notes except A. Tax anticipation notes, TANs. B. Bond anticipation notes, BANs. C. Revenue anticipation notes, RANs. D. Special assessment bonds, SABs. Answer: D. Special assessment bonds, SABs. Tax anticipation notes, TANs, bond anticipation notes, BANs, and revenue anticipation notes, RANs, are all types of short-term municipal notes issued in anticipation of future revenues or bond sales, typically maturing in 12 months or less. Special assessment bonds, SABs, however, are a type of long-term municipal bond issued to finance public works projects that benefit a specific group of property owners, with repayment coming from taxes or assessments levied on those benefiting properties. Remember, TANs, RANs, and BANs are temporary borrowing instruments, while special assessment bonds fund more permanent projects. Question 11. An issuer might choose to issue Build America bonds, BABs, rather than traditional municipal bonds because A. BABs offer a higher degree of tax exemption for investors. B. BABs are federally taxable, but the issuer receives a federal subsidy for interest payments. C. BABs are backed by the full faith and credit of the U.S. government. D. BABs allow the issuer to bypass the competitive bidding process. Answer: B. BABs are federally taxable, but the issuer receives a federal subsidy for interest payments. Build America bonds, BABs, were a specific type of municipal bond created under the American Recovery and Reinvestment Act of 2009 to help state and local governments finance capital projects. Unlike traditional municipal bonds whose interest is tax-exempt for investors, interest on BABs was federally taxable to investors. However, to make them attractive, the U.S. Treasury provided a direct payment subsidy to the issuer, typically 35% of the interest paid to bondholders. This subsidy effectively lowered the borrowing cost for municipalities while expanding the market for municipal debt to include taxable investors. Remember that BABs are a historical bond type and are no longer issued, but understanding their structure is still relevant for the exam. Question 12. When a municipal bond is quoted on a yield-to-call basis, it means the bond is A. Trading at a discount. B. Trading at a premium and likely to be called. C. Trading at par value. D. Trading at a discount and likely to be called. Answer: B. Trading at a premium and likely to be called. Municipal bonds are typically quoted on a yield-to-maturity basis, but if a bond is callable and trading at a premium, it will be quoted on a yield-to-call basis. This is because if the bond is trading at a premium, the issuer is likely to call it at the earliest possible call date to reduce their interest expense, meaning the investor will receive their principal back sooner than maturity. Quoting on a yield-to-call basis provides the investor with the lowest potential yield they could receive. For example, if a bond with a 5% coupon is trading at 105, the yield to call, if callable at 100, will be lower than the yield to maturity. Question 13. All of the following are typically included in the official statement for a new municipal bond issue except A. The legal opinion. B. The underwriter's compensation. C. The purpose of the issue. D. The financial condition of the issuer. Answer: B. The underwriter's compensation. The official statement is the primary disclosure document for new municipal bond issues, providing comprehensive information to potential investors. It includes details such as the purpose of the bond issue, the financial condition of the issuer, the security for the bonds, and the legal opinion. However, the specific compensation earned by the underwriter or syndicate members is generally not disclosed in the official statement. Think of the official statement as a public document for investors, not a private contract detail among the parties involved in the offering. Question 14. Which MSRB rule addresses political contributions by municipal finance professionals, MFPs? A. Rule G-17. B. Rule G-21. C. Rule G-37. D. Rule G-39. Answer: C. Rule G-37. MSRB Rule G-37 governs political contributions by municipal finance professionals, MFPs, and municipal securities dealers to officials of issuers with whom they do business. The primary purpose of this rule is to prevent pay-to-play practices, where political contributions might influence the awarding of municipal securities business. If an MFP makes a contribution that exceeds a de minimis amount, $250 per election per official for eligible voters, the firm is prohibited from engaging in municipal securities business with that issuer for 2 years. This rule helps ensure fairness and transparency in the municipal bond market. Question 15. The net direct debt of a municipality includes: A. Self-supporting debt such as revenue bonds. B. All general obligation debt minus any sinking fund accumulations. C. Overlapping debt from other taxing authorities. D. Long-term general obligation debt plus capital lease obligations. Answer: B. All general obligation debt minus any sinking fund accumulations. Net direct debt is a key analytical measure used when evaluating general obligation bonds. It represents the total general obligation debt of a municipality, which is debt directly backed by its taxing power, minus any fund set aside in a sinking fund for debt repayment. This calculation provides a clearer picture of the municipality's actual debt burden and its ability to meet future obligations from its general revenues. It typically excludes self-supporting revenue debt and overlapping debt, focusing only on the direct burden on the general tax base. Question 16. What is the typical tax status of interest income from municipal bonds issued by U.S. territories and possessions, example Puerto Rico, Guam? A. Federally taxable, but state and local exempt. B. Federally exempt, but state and local taxable. C. Federally exempt, and usually state and local exempt, regardless of the investor's state of residence. D. Fully taxable at all levels. Answer: C. Federally exempt, and usually state and local exempt, regardless of the investor's state of residence. Interest income from municipal bonds issued by U.S. territories and possessions, such as Puerto Rico, Guam, the U.S. Virgin Islands, and American Samoa, generally enjoys a triple tax exemption for all investors, regardless of their state of residence. This means the interest is exempt from federal, state, and local income taxes for any U.S. investor. This feature makes these bonds particularly attractive to investors in high tax brackets seeking maximum tax benefits across the board. Remember that this broad exemption is a unique characteristic of bonds from U.S. territories. Question 17. A municipal bond trading at a discount would have its yield quoted on A. Yield to call basis. B. Yield to worst basis. C. Yield to maturity basis. D. Current yield basis. Answer: C. Yield to maturity basis. When a municipal bond is trading at a discount, it is typically quoted on a yield to maturity, YTM, basis. YTM represents the total return an investor expects to receive if they hold the bond until it matures, taking into account the purchase price, coupon payments, and the capital gain or loss from the discount. Since the bond is trading below par, the issuer is unlikely to call it early, so the yield to call would be higher than the yield to maturity if the bond is trading at a discount. The YTM provides the most accurate reflection of the overall return for a bond purchased at a discount. Question 18. What is the primary method of underwriting for most new municipal bond issues? A. Negotiated underwriting. B. Competitive underwriting. C. Best efforts underwriting. D. All or none underwriting. Answer: B. Competitive underwriting. The most common method for underwriting new municipal bond issues is competitive underwriting, especially for general obligation bonds. In this process, the issuer invites various underwriting syndicates to submit sealed bids to purchase the entire bond issue. The syndicate that offers the lowest net interest cost to the issuer wins the bid and then resells the bonds to investors. This method helps ensure the issuer obtains the most favorable interest rates and terms. While negotiated underwritings occur, especially for complex revenue bond issues, competitive bidding is prevalent for its transparency and cost efficiency. Question 19. If a municipal bond is issued as a limited tax general obligation bond, it means: A. The bond's interest is only partially tax exempt. B. The amount of taxes that can be levied to support the bond is capped. C. The bond is supported by a specific revenue source, not general taxes. D. The bond can only be purchased by certain types of investors. Answer: B. The amount of taxes that can be levied to support the bond is capped. A limited tax general obligation bond is a type of GO bond where the amount of tax revenue that can be used to repay the bond is restricted or capped by law. This contrasts with an unlimited tax general obligation bond, where there are no such limitations on the issuer's ability to levy taxes to repay the debt. While limited tax GO bonds still rely on the issuer's taxing power, the limitation on taxes can make them slightly riskier than unlimited tax GO bonds. For example, a municipality's property tax rate might be capped, which limits how much it can raise for debt service. Question 20. When calculating accrued interest on a municipal bond, which day count convention is typically used? A. Actual days/actual days. B. 30 days per 360 days. C. Actual days/360 days. D. 30 days per actual days. Answer: B. 30 days per 360 days. For most municipal bonds and corporate bonds, accrued interest is calculated using a 30-day month and a 360-day year convention. This means that each month is assumed to have 30 days, regardless of the actual number of days in the month, and a year is assumed to have 360 days. This standardized approach simplifies the calculation of accrued interest, which is the interest that has accumulated since the last coupon payment date but has not yet been paid to the bondholder. For example, if a bond pays interest semi-annually on January 1st and July 1st, and it is traded on April 15th, accrued interest would be calculated for 3 months and 15 days using this convention. Question 21. Which type of municipal bond is typically considered the riskiest due to its reliance on legislative appropriation for debt service? A. General obligation bonds. B. Revenue bonds. C. Moral obligation bonds. D. Public Housing Authority, PHA bonds. Answer: C. Moral obligation bonds. Moral obligation bonds are a unique type of municipal bond that carry a higher degree of risk compared to general obligation or traditional revenue bonds. While they are usually revenue bonds, if the project's revenues are insufficient to cover debt service, the state legislature may, but is not legally obligated to, appropriate funds to make up the deficiency. This moral pledge, rather than a legal commitment, makes them riskier because repayment depends on the state's willingness, not a legal requirement, to step in. An example might be a bond issued for a state-backed authority where the state is not legally bound to pay if the authority defaults. Question 22. A customer complaint regarding municipal securities must be: A. Forwarded to the MSRB within 1 business day. B. Held by the firm for 6 years. C. Forwarded to FINRA for review. D. Reported to the local municipal securities regulator. Answer: B. Held by the firm for 6 years. Under MSRB Rule G-37, municipal securities firms must keep records of all written customer complaints for a period of 6 years. This record-keeping requirement ensures that there is a documented history of any grievances or disputes from clients concerning municipal securities transactions. While a firm must investigate complaints and take appropriate action, the immediate requirement for handling a complaint is internal record-keeping rather than external forwarding to a regulator. Always remember the various record retention requirements as they are frequently tested. Question 23. Which of the following regulatory bodies is responsible for enforcing MSRB rules on broker-dealers? A. The Municipal Securities Rulemaking Board, MSRB. B. The Securities and Exchange Commission, SEC. C. The Financial Industry Regulatory Authority, FINRA, and bank regulators. D. The U.S. Treasury Department. Answer: C. The Financial Industry Regulatory Authority, FINRA, and bank regulators. The Municipal Securities Rulemaking Board, MSRB, is a rulemaking body that creates rules for municipal securities dealers and advisors, but it does not have enforcement power itself. Instead, its rules are enforced by other regulatory bodies. For broker-dealers, MSRB rules are primarily enforced by the Financial Industry Regulatory Authority, FINRA, while federal bank regulators, like the OCC, Federal Reserve, and FDIC, enforce them for bank dealers. Remember that the MSRB sets the rules, but other bodies are responsible for ensuring compliance. Question 24. A municipality issues bonds to build a new airport. The bonds are repaid using the revenues generated from airport operations, such as landing fees and concessionaire rents. These bonds are most likely: A. General obligation bonds. B. Industrial development revenue bonds. C. Revenue bonds. D. Moral obligation bonds. Answer: C. Revenue bonds. Revenue bonds are municipal bonds whose debt service is paid solely from the revenues generated by the specific project they finance. In this scenario, the new airport's operations directly fund the bond payments. This means the bondholder's security depends entirely on the success and profitability of the airport, not on the general taxing power of the municipality. For example, bonds issued for a toll road, a water system, or a hospital would also typically be revenue bonds. Question 25. What is the standard settlement for a regular way trade of municipal bonds? A. T+1, trade date plus 1 business day. B. T+2, trade date plus 2 business days. C. T+3, trade date plus 3 business days. D. T+5, trade date plus 5 business days. Answer: B. T+2, trade date plus 2 business days. The standard settlement for a regular way trade of municipal bonds is T+2, meaning the transaction settles on the trade date plus 2 business days. This is consistent with the settlement period for most corporate securities and options. On the settlement date, the buyer pays for the bonds, and the seller delivers the bonds, completing the transaction. Understanding settlement periods is crucial as it determines when funds and securities actually change hands and when accrued interest calculations cease for the seller.